Hey everyone, welcome back to Corporate Decoder. Today S.M.N.R just filed an 8K revealing the termination of material definitive agreements, and I am seeing a critical lesson for investors on deal risk. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is essentially walking away from major deals without much to show for it. And this provides a stark example of how SPAC-related agreements can fall apart. Alright, let's dive into the latest filing from Semnur Pharmaceuticals. Incorporated, they have just announced the termination of two significant agreements. The key date here is the 20th of April 2026. This filing basically tells us that a couple of deals the company had lined up are now officially off the table. This is Semnur Pharmaceuticals Incorporated, formerly known as Denali Capital Acquisition Corporation, when it did its SPAC deal. They have common stock trading under the ticker symbol S.M.N.R and warrants trading as S.M.N.R.W. Semnur is an emerging growth company and they are choosing not to opt out of extended transition periods for accounting standards. You often see this with smaller companies trying to manage their reporting burdens. The main event in this filing is under item 1.02, which covers the termination of a material definitive agreement. This is where they explain why certain important contracts are now void. The filing talks about a deal called the PIPE SPA, which stands for Private Investment in Public Equity. This is a common way for companies, especially those coming out of a SPAC merger, to raise additional money. Remember, Semnur Pharmaceuticals went public through a SPAC merger with Denali Capital Acquisition Corp. This business combination happened back in September of 2025. Now, back on the 20th of August 2025, prior to the SPAC merger closing, Semnur entered into a securities purchase agreement with JW Capital Securities Limited. The idea was for JW Capital to buy 125,000 shares of Semnur's common stock at $16 per share once the business combination was complete. However, the closing of this deal was pushed back several times. Importantly, as of the date of this filing, no shares were ever actually issued under this agreement. So on the 20th of April 2026, Semnur officially sent a notice to JW Capital Securities Limited terminating this agreement. It is now completely over. This means the company did not get that planned investment from this particular investor. Now, this next part is pretty similar. They also had another agreement called the Semnur Biconomy SPA. This agreement was made on the 23rd of September 2025 with a company called Biconomy Pta Limited. Here, Semnur agreed to sell 6,250,000 shares of its common stock to Biconomy for $16 per share. What is interesting is that this payment was supposed to be made in Bitcoin. Again, as of the date of this filing. No shares were ever issued under this agreement either. Just like the first deal, on the 20th of April 2026, Semnur sent a termination notice to Biconomy, effectively ending this agreement as well. So Biconomy's planned investment in Semnur, which was to be paid in Bitcoin, is also off the table. Now, what does this all mean for Semnur Pharmaceuticals? This filing essentially reveals that two planned capital raises, one for 1.25 million shares and another for 6.25 million shares, both at $16 per share, totaling approximately $120 million in potential funding, have been terminated without the company receiving any money or issuing any shares. When SPACs go through their initial merger, they often have PIPE deals lined up to bring in additional cash. These deals are crucial because they can provide essential funding for the company's operations and growth plans. When these pipes fall apart, as they have here for Semnur, it can signal a few things. First, it might mean that the investors in these pipes lost confidence in the company's prospects, or the terms of the deal became unfavorable. Second, it means the company is missing out on that intended capital infusion. For a company like Semnur, which is likely still in a growth phase after its SPAC merger, a lack of funding can seriously impact its ability to execute its strategy. The news headlines from around this time, like Semnur Pharmaceuticals, S.M.N.R cancels PIPE deals for 7.5 M shares at $16, and Semnur Pharmaceuticals ends two securities purchase agreements without share issuance. Confirmed that this was a notable event, this cancellation of planned investments basically means the company did not get the significant cash injection. It was anticipating. This raises questions about their financial runway and their ability to fund operations and future projects without these funds. Historically, when companies, especially those that have recently gone public via SPAC, fail to secure these crucial PIPE investments, it can put immediate pressure on their financial health. We've seen similar situations with other SPAC-related companies where the inability to close these deals led to significant operational challenges and stock price declines. For example, many post-SPAC companies with market caps under $500 million have seen their stock prices decline by 70 to 90% in the year following their merger, and a failure to secure funding like this can accelerate that trend. The fact that these deals were terminated without any shares being issued suggests they were unable to meet the closing conditions or the market conditions shifted unfavorably. Looking at the broader picture, Semnur is an emerging growth company with a small team. The fact that they were unable to close these deals, especially one involving payment in Bitcoin, which could have indicated interest in innovative payment methods, is concerning. It suggests potential weakness in their financial strategy or investor appeal at this moment. The biggest takeaway here is that investors should always be wary of deals that are announced but not closed, especially in the SPAC world. The PIPE SPA termination and the Biconomy SPA termination highlight the risks associated with these types of financing agreements. They are not guaranteed funds until they actually close and the money is in the bank. In my opinion, Semnur Pharmaceuticals is facing a significant challenge in securing the necessary capital. The termination of these two agreements means they are now operating without a substantial planned funding source. This could lead to a slower pace of development, potential cost, cutting measures, or a need to seek alternative financing, which might come with even less favourable terms. The risk I am watching is how they will make up for this lost funding and what impact it will have on their operational timeline and ability to compete. What I am actually looking for is any new disclosure about their financing plans moving forward. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.